Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. My guest for this episode is Clare Bolingford, the Director of Banking and Insurance Conduct at the Financial Markets Authority, or the FMA. Welcome, Clare, and thanks for joining us. Clare's here to talk about the incoming Conduct of Financial Institutions regime. This follows conduct and culture reviews of both banks and life insurers, which were undertaken by the FMA and the Reserve Bank back in 2018 and 2019, of course after the high-profile Australian Royal Commission on the Financial Services sector. One of the ways the Conduct of Financial Institutions, or COFI regime, has been described to me is that it's a major shift essentially from a buyer beware culture to something more akin to a fiduciary duty of care where a bank or an insurer must act in the best interests of their customer. Is this how you see it?
Kia ora, Gareth. So what the new regime does is that it puts a legal obligation on banks and insurers to make sure that they are treating customers fairly. That's the central principle. So in terms of a duty, it doesn't quite go that far in law. It's actually something that the FCA in the UK has now brought in, is that type of consumer duty. But what this does is it requires those institutions to have fair conduct programs in place to ensure that they are meeting the principle of treating their customers fairly.
So what is a fair conduct program?
So there are particular things that the institutions need to have regard to when they're developing their fair conduct programs. And indeed, many of the institutions will have thought quite a lot about this already following the culture and conduct reviews. But essentially, what they need to be doing is considering how they treat their customers throughout the experience that they have with the firm. And that's right from a point where they're selling a product all the way through the provision of a service to that customer, and then possibly at the end of the relationship as well. So as we know, some products are quite long-term in terms of that relationship that a customer has with the firm. And it's really to ensure that all of their processes, all of their systems, and particularly the controls they have in place are thought about in that customer-centric way.
So it is quite a change, I guess. It's a new era in the regulation of financial institutions and their services. The FMA and Reserve Bank review of New Zealand banks back in 2018 and turned up some things that weren't particularly good, but the conclusion was that conduct and culture issues didn't appear to be too widespread, that is, problems. So why is this change needed, and I guess what problem or problems are you looking to address here?
So I think what we found during the reviews was that although there wasn't widespread and systemic misconduct in the industry, there were a lot of weaknesses which could give rise to problems in the future. And indeed, what we have seen since the firms have been doing a great job reviewing the products and their processes and their controls is that they keep turning up more issues that have been from the past, where perhaps there wasn't a customer-centric view or there weren't the appropriate controls in place to make sure that good customer outcomes were achieved. So over time, as firms have now concentrated their attention more on getting it right, we've found that some of the product design needs to be changed. Some of the products need to be altered to make them more suitable for people. But particularly previously, they weren't picking up perhaps as proactively where there were issues, and there's needed to be a reasonable amount of remediation. So money paid back to customers where they've lost out in the past because of that.
Have you tallied all that up? I mean, there's been quite a lot. I mean, I can recall there were specific issues that came out of the review in 2018, 2019, and there have been a few more, I think quite a few self-reported to the FMA. Have you tallied up the number of them and I guess the reimbursement that's been paid?
Yeah, so as you say, we have had a number of self-reports coming through since the reviews from the industry, which is actually really good news because it means they're going and looking and then fixing the problems that they're finding. And we do expect that to continue as firms go through their books. And certainly there are some firms that probably need to do a bit more work to try harder to spot the issues that have occurred already. We know that it's running into the tens of millions now across the industry. And I haven't got the number to hand on me as to the exact number, but it's certainly a good degree more than it was when we commissioned the reviews in the first place.
And it seems like most of our major, certainly banks, have been involved in this.
That's right. I mean, I think they all had, following the reviews, had action plans to implement. So they all had issues that needed resolution, particularly when it came to, as I said, some of those weaknesses that we found in their systems and controls. But what we're trying to get to with this regime is actually this needs to be an ongoing area of focus. And I think it's to ensure that banks are being much more proactive in terms of thinking about the customer, what potential impact or what actual impacts customers are experiencing, and going out and testing that from time to time as part of that evolving fair conduct program. So these programs aren't at one point in time piece. They are programs that will need to evolve and change depending on the nature of the business, depending on the customers, depending on the product set. So what we're expecting of firms now is actually to be going out and regularly reviewing what's really happening on the ground, what's actually happening in practice, and how customers are experiencing their services.
So I guess is the real core of the conduct of financial institutions regime, is it that the views formed that maybe they were not, or definitely they were not, putting the customer first? Perhaps they were prioritising their own, financial returns or whatever it was, and you really want them to be focused on what they're doing for the customer.
That's right. So, I don't think anyone who works in banking goes to work in the morning wanting to rip off customers or to get bad outcomes for their customers. But banks have a lot of things they need to focus on as part of the business that they do. Part of that is making sure that they have, a good sustainable business model, which means charging the right prices. It means making sure that their products are out there in the markets. And it also obviously means that they are prudent with the money that they use. What we want to do is make sure that customers are very much part of that decision making as well. And I think it can be easy with so many things going on in the environment to take your eye off the ball if you don't have that front and centre of your strategy. So what we found during the reviews was that it wasn't necessarily that banks were intending to harm their customers, but maybe there wasn't that proactive focus that we're now expecting. And certainly there wasn't that look back to make sure that everything had actually gone the way that they'd expected it to.
So from the perspective of consumers, or I guess the public in general, how will this regime benefit them, and what changes can they expect to see?
So I think hopefully customers will already have seen some changes from the banks since the reviews. We know that they have put a lot of effort into making sure that their controls are more robust and that they can pick things up more quickly if something has gone wrong. Because in any relationship, you're going to have issues from time to time. So what I think customers should be expecting from their banks once the regime's in place is that they've got a good understanding of how the relationship works. All the communications are clear, so actually they're helped to make some of the decisions they need to make as part of their financial well-being. So it is about having that access to the services. It is about having really good conversations about what they need and being able to fix things when things go wrong. So we know from our consumer survey that we recently commissioned, for example, that there's quite a low number of people that actually know how to complain or feel that they don't really know how to complain. I think it's about a third. And that's quite a worry for us. So really, we want to be in a space where customers feel very confident and assured and trust their financial services providers to provide that service, have good access, but if things go wrong, that they're treated fairly along the way.
You've described the intention of the COFI regime as being to cover the entire life cycle of a financial product. I think it was an article that you wrote, or maybe it was a speech I was reading preparing for this. And you said that for something like a health insurance product, for example, or health insurance, this could literally mean from the day you're born until the day you die. So we're talking a very, very long time frame, hopefully, for most people there. And you suggested that it even covers the product design. So I guess, the this sounds like a lot of work. Is it a realistic expectation that people are going to, I guess, cover the entire life cycle of a product like that?
So I think it is realistic if you get, as an institution, you get yourself and your people into the right mindset. So it is about just thinking about what the impact can be on a customer, and really you obviously want positive impacts coming throughout the life cycle of the firm. The life cycle of the product and service that customers experience. So it's very important at product design phase to have the customer in mind. We have seen in the marketplace before products that can be suitable for some customers but actually aren't suitable for everybody. And at the product design phase, it's really important to identify that and think about, well, actually, what type of people could this be suitable for, and how might they use it in practice? And that kind of customer-centric thinking will really help with targeting the business towards who might benefit most from that, and then also make sure that ultimately the right people are able to access the right services at the end of the day. So, as an example, we did a piece of work on credit card replacement insurance, which can be a good product for people to protect themselves if they get into difficulties and can't pay their credit card, and gives them some protection there. Unfortunately, what we found was that because possibly these issues weren't picked up at the product design phase, the sales processes actually meant that it was being sold to people that it was unsuitable for. And that wasn't picked up early enough in the piece. And that has led to a number of issues occurring for customers where they've either tried to claim and can't claim because they're not eligible, so they should never have held the product in the first place, or indeed they were paying for something that they didn't really need at all. It wasn't something that was suitable for them. So, the institutions have had to pay money back to people because of that, because of the way it was sold, because of the way it was designed. So I do think, it's not just issues for the customer if you don't think through the life cycle of a product. It's also, issues for the firm if they're not really thinking about the customer at all stages.
Keen to ask you about the role of intermediaries. I guess my first sort of question on that is who will be classed as an intermediary? I know there's a lot of work going on in other areas that impacts on this. There's been a lot of, I guess, reviews and changes in financial regulation in New Zealand in recent years. So who is an intermediary under this new COFI regime? And I guess the second part to that question is around incentives and commissions, and what are going to be the rules for what financial institutions can pay them and how, because we've obviously seen a lot of that in the past, and insurers offering overseas trips for people who made lots of sales and all that type of thing. So I guess that's kind of a two-part question.
Sure. So in terms of who intermediaries are, it can be quite broad, but effectively it's anyone who intermediates between a customer and a provider, in this case a financial institution. So quite often we're talking about financial advisors there. So that could be a mortgage advisor who's advising a customer on what type of product and what's available in the marketplace. It could be an insurance advisor who's doing a very similar role but for a different product set. So in terms of the incentives that go around that, there are different incentives that are available to providers to make sure that they can sell products through these intermediaries. And there is an inherent conflict of interest there. The intermediaries, the majority of which are regulated through the financial advice regime, which has been recently updated. And they are subject to a code of practice that means they do have to have the best interest of their clients at heart. But we know that we're all human beings at the end of the day. So if there are very high incentives that are being offered that could conflict with that, then that could pose a challenge. So what our expectations are of the institutions is that actually as part of their fair conduct programme, they are thinking about how they're setting those incentives, whether they be referral fees, whether they be commission, to make sure that they are managing as much as possible that conflict of interest that might arise in those circumstances. But the regulations MB are currently consulting on will go further than that and actually ban volume and value-based sales incentives as part of the COFI regime. So that effectively means that it takes that more damaging type of conflict, as we've seen here and in other jurisdictions, that pressure to try and, within a certain period of time, meet a particular target in terms of sales volumes, which we have seen leads to potential mis-selling and unsuitable products being sold to customers. But certainly fees and commissions can be used and will be able to be used in the future regime.
To what extent will they need to be disclosed? So if I'm using a mortgage broker or an insurance advisor is talking to me about life insurance products, how much do they need to tell me in terms of how they're being remunerated?
So disclosing the method of the way that they're getting paid for a financial advisor is part of the new regime. So there are requirements at different stages of that process that they'll need to tell customers about how they're remunerated effectively and what that looks like in practice. So that's part of the new financial advice regime.
And what about, I guess, punishment for the ones who do break the law, whether it be institutions or individuals? What sort of punishments could they face?
So we, as the new regime comes into force, the FMA will have all of the current powers for financial institutions as it does for the rest of our licensed population under our Act. So that could be anything from stop orders if we feel that there's such a big issue happening that we just need to immediately put a stop to it, all the way through to taking court action against institutions and potentially fining them. So we have we will have the full suite of current powers that we have available to take action where we see misconduct happening. That's just for the institutions. So under our current regime, there are no individual penalties in that sense.
Are there any proposed?
Not that I'm aware of at this time.
What about whistleblowers? I mean, they can obviously serve a very useful function. What sort of role or protection will there be for whistleblowers?
So within the COFI regime, there are whistleblower protections that will apply if a whistleblower approaches the FMA. And certainly we would expect and do expect financial institutions to have their own whistleblowing policies in place that have the appropriate controls and governance around those. But I would say actually whistleblowing is kind of a last resort. That's absolutely something that there are expectations around in terms of those protections. But what we really want to see from firms are having good cultures in place, which means that people actually are able to speak up. And there's a level of what we call psychological safety. If people are concerned or feel that something's going wrong, that they can actually raise that without there being blame or without there being consequences for them. And we'd really hope that within institutions, staff can do that without having to resort to whistleblowing policies, which effectively are, they're the kind of final backstop, I think, that people can take when they're really concerned that something bad's happening.
So what are the key timeframes for the Conduct of Financial Institutions regime? I mean, when's it all going to take effect?
So currently, the proposed timetable is that the licensing regime or the licensing window will open from around mid next year. So we're in the process of helping the industry prepare for that at the moment. We're getting out some guidance and setting our standard conditions for that at the moment. But the regime itself will then come into force after we've done that licensing process, and that's expected to be in early 2025.
So how will the licensing work, and who needs the licenses?
Anyone who's a financial institution who provides services to retail customers effectively will need a license from us. If they don't have retail customers and don't intend to, then they won't need a license from us. They will just stay being regulated purely by the Reserve Bank. And in terms of what that will look like, it will, in process terms, look very similar to what we've done for the financial advisor community. So there'll effectively be an online form to fill in, and then we take the process from there in terms of the information that they'll provide to us. But it will be very much based on what's in the legislation and the standard conditions, which we are in the process of consulting on.
Just in terms of establishing a conduct regime for financial institutions, has the FMA, or I guess New Zealand more broadly, looked at what's happened in other countries and have we taken a lead from there or bits and pieces from there? And I guess also, is there any concern about getting too prescriptive? And because traditionally New Zealand's been very principles-based, or like to think it's been very principles-based. So I'm just wondering, is there any danger of getting too prescriptive? Is that something you've kept in the back of your minds through this process?
Absolutely. I think that there's always a really important balance to strike. And as you say, I think New Zealand's legislation, and certainly the financial services legislation that the FMA is responsible for, has kept that kind of principle-based level where it's been possible to do so. We've definitely looked at other conduct regimes in other jurisdictions. I was privileged to work in the UK Financial Conduct Authority and Financial Services Authority before that, who are very much been at the forefront of some of the conduct regulation.
How long has that been in place in the UK for?
So conduct regulation has certainly been in place. So I can't go back further than my own experience, but when 1997, when the single regulator came together as the FSA, that was a prudential and conduct regulator, and had those a number of the principles in place that underpin conduct, such as treating customers fairly, for example. As I said, they've kind of moved on beyond that now to this new customer duty, which we're looking at with a lot of interest, not from a legal perspective so much, but just some of the concepts and what they're including in there, because it very much moves on to a more outcomes focus approach. And that's something that we would very much like to emulate here in New Zealand. I think we've got a real opportunity here, not only to keep that principles-based approach rather than very prescriptive rules, which frankly don't work so well for conduct anyway, I think in my experience, and certainly the experience we've seen in other jurisdictions like Australia. If you do start getting prescriptive, that can have some unintended consequences and actually can sometimes cause as much harm as it is trying to address. So what we would like to do is focus on the policy intent. We like to focus on the outcomes for customers and ensuring there are fair outcomes achieved through this process. And I think there's always a challenge because firms obviously are very keen to make sure that they're complying with legislation. And so they want to know what is it we need to do in order to comply with this. But to be very specific does mean prescriptive rules. And this is designed to be a much more flexible regime. And it means that the regime can flex to the business model of the firm. It can flex to the type of customers that they have. But it does make it harder then to think about, well, in practice, what do we need to do to make sure that we can assure ourselves that the conduct is good within the organisation and that our customers are getting a good experience through this process. It's not a tick box exercise. You can't say, well, we've got our fair conduct in place, program in place, and we're done. It's going to need a lot of thinking and really embedding in the organisation to get that right. So we have looked, as I said, at the experiences of other countries, and I think we're in a great position to really get the best out of this regime, so it can be a win for the financial institutions in terms of that sustainability, in terms of making sure that their customers have a great experience, and also a win for the customers. But we're very keen to keep it without prescriptive rules unless they're really necessary.
So how will we judge whether the conduct of financial institutions regime is a success? How is it possible to measure that? And how's the FMA going to think about that?
So yeah, we're going to need to spend a bit of time thinking about the methods of measuring that. But I think what we're looking for ultimately is that customers can have trust and confidence in the institutions that they get their products and services from, and they have products that are suitable for their needs. So, we're very keen, and I know the institutions themselves are very keen. Financial well-being is so important for people. It's just such a fundamental part of people's lives, and being able to have access to really good quality financial products and those products serving customers when they need them is incredibly important for their well-being. What we really want to see is that customers are getting those products and can use them appropriately. And I think we know, though, that from time to time things will go wrong. So what we really want to see is that those are picked up quickly, hopefully proactively, so risks are addressed before they actually turn into problems. But where that's not possible, that people are put right quickly, because that, again, builds that trust and confidence that they're getting what they need from their providers.
Well, look, thanks a lot for that, Claire. That's Clare Bolingford, who's the Director of Banking and Insurance Conduct at the Financial Markets Authority. And I'm Gareth Vaughan at interest.co.nz with another episode of our Of Interest podcast.